Hi, today we're going to talk about how to fix accounting errors. So what are the accounting errors? To be classified as accounting errors, you must make a mistake. So for example, you can use accounting principle, which are not US GAAP. You make mistakes in calculation and you estimate not in good faith. So all kind of mistakes, the key point is that you must did intentionally, or you definitely have mathematical mistakes, okay? It has to be wrong. So here, before you start fix your mistake, the first step is to identify what type of mistake it is. If you have a wrong journal entry, which only affect the balance sheet account, and then the solution is very simple. You just need to do adjusting entry by debit one balance sheet account, credit another balance sheet account, essentially just reclassify it. Okay, so these are very simple. The reason is because the balance sheet account, they get carried over. So as long as you fix the financial statement, your statement you presented, it has no impact on the income statement, and all accounts should be correct. The second type of common mistake is the mistakes involve at least one account on the income statement. So here, if you have one account involved in income statement, you have to look at when the mistake was discovered and when the mistake was made. And so here, if at the time of discovery, the book is not closed, and you just need to reverse the incorrect journal entries and rebook the correct journal entries. What do I mean by book is not closed? Which means you made mistakes in the current period, but the financial statement have not been created. And alternatively, you can make one adjusting entry just to reverse the difference between the wrong and the correct journal entries. Yeah. How about the second scenario? What happened if the book is closed? For example, you can make a mistake in prior period and you discovered in the current period, or you made a mistake in the current period, but the financial statement have already been created at the time of discovery. If a book is closed, you have to make adjusting entry. In this adjusting entry, only retained earnings account and a balance sheet account can be used. You can't use any income statement account because when the book is closed, all income statement account balance has been reset to zero. Therefore, there's no meaning for you to make any adjustment to income statement account. And so what you need to do first to calculate what is the cumulative impact of your mistakes on the return earnings. Here, this is cumulative impact on return earnings have to be after tax, because anything goes through return earnings, like after tax number. After you calculate what is the cumulative impact, you just make adjusting entries and by debit return earnings and credit the related balance sheet account. When you present, this adjustment has to be presented as an adjustment to the return earnings for the earliest period reported. So for example, you only report one period, and then the adjustment is going to be made to the beginning balance for return earnings for the current period. If you report the comparative financial statement, which means you report a multiple financial statement, in that case, the adjustment has to be made for the earliest period reported. So let's take a look at two examples. Example number one, on December 12, year one, investment in security, equity security costing 78,000 was sold for 97,500. The total of sales proceed was credited to the investment in equity security account. So here, this is an accounting mistake because for this equity security, the book value is 78,000. and the fair market value is 97,500. So this difference should be captured by a gain or loss account. For the mistake, the entire sales proceed was credited to the investment in equity securities, so they didn't really separate the loss, the gains from the rest of the proceed. All right. So how do you fix it depending on whether the book is closed or not? Okay, so here, case number 1, the book is still open. The mistake was discovered before the book adjusted in the year. The second case, the book is already closed and you discover the mistake next year. So let's take a look at how we're gonna fix it. So case number 1, to fix this, first we have to know what's the wrong journal entry. The wrong journal entry is you debit cash and credit the entire sales proceed to investment in equity. This is a wrong journal entry. The correct journal entry should be you debit cash, but you split the sales proceed into investment in equity securities and gains on sales. So here, when you make adjusting entries, you can just take a look at the difference between wrong and the correct journal entries, and then book the journal entry to capture the difference. So here, adjusting entry is just going to be, you're going to debit investment in equity securities and credit gain on sales on investment in equity security. Yeah, the reason you're doing this is because you can see here, due to this wrong journal entry, you understate investment in equity securities and you understate gains on sales. So here, this is one adjusting entry way to fix it. Alternatively, you can just reverse the wrong journal entry and rebook the correct journal entry. So what happened if you actually didn't discover this mistake this year and you discovered a mistake the year after? In that case, first you have to see what's the cumulative impact prior to year 2. So here, the cumulative impact due to this mistake, as we talk about here, is you understate the investment in equity, you understate the gains and losses. So when you understate the gain on sales, you understate the net income, and then you understate the retained earnings. Therefore, you know the cumulative impact will be understate investment in equity, understatement in retained earnings. So to fix it, you just need to credit the retained earnings and debit investment in equity securities. Again, here, because the book is closed, when you make this journal entry, you can only use the retained earnings account and accounts from the balance sheet. And here, the retained earnings is captured the cumulative impact of these accounting errors. Let's take a look at second example. For the second example, during the auditing, there was a mistake discovered, and the mistake is related to the depreciations. And the company purchased a machine for 510,000 with a salvage value of 51,000, useful life of 5 years. But the bookkeeper uses straight line depreciation, but they forgot to deduct the salvage value when they're calculating the depreciation expense. So the mistake was for the past 3 years, 2010, 2011, and 2012. And they said prepare the journal entries in 2012 to correct the books. They're assuming in 2012, book have not been closed. Here, the mistake is in 2010, 2011, 2012. For 2010 and 2011, these 2 years, book have already been closed. But for 2012, this year, the book is still open. Therefore, you have to treat these 2 types of mistakes differently, because for one type of mistakes, the book has already been closed. Another type of mistakes, the book are still open. All right, let's take a look at the wrong journal entries. So the wrong journal entries is like did the depreciation expense, debit, and accumulated depreciation credit, but the amount is wrong. It should be 91,800, but the depreciation expense and accumulated depreciation were overstated. They booked as 102,000, and therefore these are the wrong journal entries has been repeated 3 times in 2010, 2011, and 2012. So let's take a look at how to fix this. First, just look at this wrong and the correct journal entries. The difference between these two, 102,000 and 91,800, is 10,200. Okay, so to fix it, first look at 2010 and 2011, and we know for these 2 mistakes, book is closed. So you're going to use one retained earnings, one balance sheet account, and here we use retained earnings credit, accumulated depreciation debit. The reason is here we calculated the cumulative effect, which is the difference between 102,000 and 91,800. And we multiplied by 2, so the cumulative difference is 20,400. And we know the depreciation expense was overstated due to the mistake. And therefore, when you overstate the depreciation expense, you understate that income, you understate the retained earnings. Therefore, to fix it, you have to increase retained earnings by credit retained earnings. So here we credit retained earnings 20,400. And then we need another account from balance sheet. So the related account is accumulated depreciation. That's why we debit accumulated depreciation 20,400, and we credit retained earnings by 20,400. For the next mistake, which is the mistake made in 2012, for this mistake, the book is not closed, and therefore we can just really look at the difference between wrong journal entries and correct journal entries, make adjusting entry to capture the difference and reverse the mistake. And here we know the wrong journal entry overstated the depreciation and overstated the accumulated depreciation. Therefore, we just need to debit accumulated depreciation and credit the depreciation expense here by 10,200, which is a 1-year mistake. So that's all.